is Max Kulyk, and I am the CEO and founder of Chicory Wealth. And today we're going to be talking about um, the larger macro environment that has persuaded us to do something we've never done before, which is to add some precious metals into our core portfolio. And we're going to talk a lot about the why now of that and our thoughts on what is happening that's driving that. Um, and I'll just start by saying I'm joined today by Daniel McNabb and Christian. I just realized, Christian,
G-
that I'm not entirely
Giadolor.
sure. Thank you, Giadolor. I was like, oh, I don't want to screw that up. Can you say my last name, Christian? That's to talk about this, or part of our investment team. Um, I'll say before we start that historically, this has not been our position for lots of reasons that we will discuss. But one of the primary reasons we have never used gold before is that we've always been concerned about the sustainability elements of that and how one gets it, et cetera, et cetera. So when we did make the decision to turn in this direction, we worked very hard to find something that was traceable, significantly less bad from an environmental standpoint, and we'll talk more about that. So let me just say a couple of things. Uh, and actually, you know what? I'm going to let you do this, Daniel. Tell us a little bit
Mhm.
about what we mean when we say buying gold.
Mhm.
Because what we're not doing is we're not taking physical possession of gold and holding it in, an
Mhm.
undeterminable location somewhere, in the Atlanta vicinity. So can you
Mhm.
can you talk a little bit about what we're talking about when we say this?
Sure. So, of course, folks can individually buy bars and coins of gold and store it, in a bank safety deposit box. But what we are talking about when we buy
Joe.
gold for our clients, for you all, is buying. It's an ETF, so it's traded like a stock. Um, However, the uh, shares are backed up by physical gold. So there are numerous kind of instruments like this that you can buy. Um, and the one that we chose is the one that is uh, most replicates actually owning gold. So it is their shares uh, are directly correlated to the price of gold. And you can, if you have a fair amount, you can actually go to the vault where the gold is stored and exchange your shares for physical gold. Now, there are some considerations there. It has to be like a larger amount, but in theory, right, you can actually go get physical gold with your ETF shares. So that is a difference to a lot of the options kind of in the market. There's lots of these things out there, but basically, it's kind of like a proxy for physical gold that is held in your account. It looks like its own stock. The ticker symbol, the symbol you'll see is PHYS, and that is the individual position for the physical gold in your portfolio. Um,
Daniel, remind me where the actual gold lives. You said it to me the other day when we were talking about this, but I forget.
yeah, so it's in the Canadian Mint vault. So it's not a private bank vault where um, a lot of these other funds will store their gold. It is a governmental entity. So the Royal Canadian Mint Vault.
Okay.
And so that is the sole custodian for that for the fund that we've selected. A lot of the other funds will spread theirs out across various banks, but this one is just the Canadian Mint.
Well, we're going to come back to why we like it besides the fact that you can exchange it for actual gold. But um, why now? We talked a lot about why we're doing this now, and we've talked internally about why we've made this. I mean, there is a
Mhm.
way in which we're saying that conditions have changed, and that is what's driving us to take even this small position. Do you want to speak to the
Mhm.
conditions that have changed and why we've come to this conclusion that we, despite a history of never having done this, have chosen to do this now?
Sure. So there are a number of reasons why. So the first is kind of growing instability and a general move away from the United States dollar as a major reserve currency. So the U.S. has always been a very stable currency, and historically, lots of countries will use U.S. dollars as kind of their store of wealth, and as a store of stability in their central banks, which is kind of their main bank that lends to other banks and that backs up the currency of each country. So people, a lot of these countries were using the U.S. dollar. A couple of things have changed. In 2022, a lot of this was based off of the sanctions that the U.S. levied on Russia after its invasion of Ukraine, where they basically froze the assets of the Russian central bank, all of the assets that they could freeze, a lot of those, dollar assets. Um, and countries took note of this. And a lot of these countries began to think that, okay, using the US dollar as my reserve currency now might not be in my best interest, um, because the US will have a lot of power over me, essentially, and can levy sanctions and all sorts of things. And so the best alternative to US dollars is gold because of its stability, its long-term price appreciation, um, and how it performs very well during periods of geopolitical instability. And so we saw this trend of a lot of these emerging markets begin to purchase more and more gold, uh, to add to their central bank kind of balance sheet to kind of fill their coffers with gold instead of with dollars. And so we see this trend of the dollar becoming weaker, becoming potentially devalued. We've seen continued deficit spending in the US by both political parties. It seems a near congenital need to deficit spend in this country to prop up our economy. And it's only accelerating. So the it appears, especially under this current administration, that devaluing the U.S. dollar is a key plan that the U.S. has, which will help it
Accommodate the debt.
meet meet its debt
Mhm.
obligations. Um,
So to just
so
pause you for a minute, because I
yeah,
want to drive home this point. So,
yeah.
sanctions against Russia, certainly few of us here probably would argue that something had to be done and that was a lever to pull.
Mhm.
But Russia had most of its reserves, or a good bit of its reserves, in US treasuries. And so, as a consequence of being able to freeze that, it's one thing when it's frozen. I'm going to editorialize here, but that's part of my job. Um, you know, it was one thing to freeze it under a government that's trustworthy. It's another to freeze it under a government that has a bit more lack of trustworthiness in terms of our historical allies,
Mhm.
right? So the ability to do that and to freeze those assets has made even what had been our historical allies rethink their relationship to the U.S. dollar in the form of treasuries as a essentially like underpinning of all, the so-called risk-free asset around which the whole world economy had revolved for the last, I don't know, 60 or 70 years, something like that,
Hmm.
after we went off the gold standard in the 70s. So now we have a situation of a less stable government, a government more willing to punish what might have been friends, cozy up to what might have been enemies, and it's causing a rethink globally in terms of value of the dollar. And the answer to that has been to accumulate gold. And the two number one countries accumulating the most, I believe, are China and Poland. Am I correct about that?
Hmm.
And
Yep.
when China is sort of like a no-brainer, okay, that makes sense because China's trying to. But Poland is interesting, and I've read that Poland is doing it in part as a bulwark against being so close to um, Eastern Europe potentially. But I mean, I
Hmm.
suppose. But that whole move is the big price driver, right? In what's been driving up the price of gold.
Hmm. That's
And
right.
and so um, so it isn't just like institutional investors, it isn't just retail investors. It's actually central banks, a long-term program. So this is the kind of like structural change we're seeing. This is a key piece of the structural change we're seeing that has made us say this trend line we don't think is going away. And I asked you when we were talking the other day in preparation for this, um, uh, what would have us come off this thesis that this is a long-term trend? How would we know we were wrong?
Mhm. Right. Well, generally, when you have higher interest rates, you would prefer to hold some asset that is paying you a higher rate of interest. Obviously, gold does not pay you interest. So, an environment where uh, trade barriers break down, you have lots of growth, multilateralism is abundant. So, basically, we're as a species on this planet, we are moving resources efficiently from one place on the planet to another, less trade barriers, less conflict. Gold would not have as much uh, demand, likely. There would not be as much demand for gold because you could, invest in the economy, and the economy would really hum along a lot better than it is likely to do over the, in the short to medium term here. We've seen a lot. We've seen a lot of tariffs being levied, a lot of trade rhetoric that really implies that we're moving more towards kind of isolationism, which is fairly inefficient. And so you could see a lot of potential investments um, do worse in such an environment. And currencies, specifically the US currency, which has hedged everything, um, you know, doing worse. And so an environment where the US continues its trajectory is likely to be good for gold, and one where we really pull it back, mend ties, drop trade barriers, especially with Canada and Mexico. Um, you could probably see gold demand from central banks go down. And really the main driver of gold prices is this difference between supply and demand. So supply comes from a fairly fixed number of gold mines. There is some recycling also, but so demand is really the main driver, and demand is very elevated right now. It has been over the past 3 years. Central banks buying over 1,000 tons a year. In 2025, that actually declined to slightly under 900 tons, but they're still buying a lot of gold, even though the prices have gone up significantly. Um, and so, you know, if there is a situation where they say, okay, we actually have a lot of faith in the U.S. now, or have faith in some other nation that emerges as the kind of new reserve currency, and relative to gold, which yields nothing in terms of interest payments, they can get 5-6% interest on their U.S. Treasuries. Now that's around 4%, but it's more than zero. Uh,
Mhm.
and the risk of that is lessened for them, then they may move back towards towards that uh, posturing. But we think that is unlikely, given the trajectory of where we are going. We still have 3 more years under this administration. And even after that, it's likely that a lot of the rifts that have emerged are not going to be mended anytime soon. There's kind of irreparable damage. And Christian, I don't know, please chime in here whenever you like. Um, it's definitely something that we think is a long-term hold. This is not a play that we are trying to just make because of this administration. It's a long-term structural shift in posturing, and um, there are lots of reasons for it, including just general diversification in the portfolio. But yeah, the main uh, scenario in which gold would do poorly is a scenario in which other assets do very well.
Right. So, well, Christian, go ahead. Come on in.
I'll add to that what you're saying, Daniel. The World Gold Council commissioned a poll to central banks back in 2025 to get a sense of who was purchasing gold, who expected global gold holdings to increase. And 95% of central bankers said that they expected global gold holdings to increase. 5% said they expected it to stay the same. But that just illustrates kind of this secular stickiness around central bank demand for gold. Now, China in particular, their share of gold to their overall currency reserves is about 8%. And for most developed world economies, it's closer to 50%. So it also helps to illustrate just the amount of room that China has to go as they buy more gold and try to get closer to having that reserve currency type status.
Hmm. Hmm. Interesting.
Mhm.
So essentially, we've unleashed a new trend of the United States. The confluence of events has unleashed a new trend line in relationship to this, where we
Mhm.
think the dollar no longer is going to be as preeminent as it has been. It's no longer going to be the predominant store of value for world economies and other world central banks. And it's got to go somewhere, and it's not going to Bitcoin, so it's going to gold.
Mhm.
Basically, right? It's going to gold. Um, yeah, and I take your point, both of your points that um, we can't. It doesn't look like it's going to be very easy to put Pandora back in her box. That is to say, as the old saying goes, right? It takes years to build trust and about 5 minutes to ruin it, and it's been ruined. And so, just recalibrating that, new administrations are not going to be enough, no matter the administration, to probably, because there was already, I mean, I've been doing this 24 years or something now, and I was always getting questions throughout my career about, well, at what point is the dollar no longer the reserve currency? To which I always add, well, probably someday, but it's still the best looking horse in the glue factory, right? And now, not so much. Now, gold is starting to look, gold is much more, it's ubiquitous, it's fungible, it's not governed by, it's not a fiat currency. It's not subject to the same political whims of administrations, etc. And so here we are. But to your point, it doesn't pay interest. It doesn't have earnings. You hold it as you hold it on the assumption that it continues to rise in value or doesn't lose very much value, and that it maintains its value relative to currencies, in our case particularly, the dollar becoming worth less and less in terms of its purchasing power. Am I right? That's the point. So it
Mhm.
sits there, it hangs out, and so as a consequence of that, um, just because this is going to happen, I'm sure from time to time, even if we're right about this, that there are going to be sell-offs in gold, like there have been recently. And my interpretation, and I'd like to hear yours, is that if you've got asset holders, institutional asset holders that are leveraged against, say, technology stocks or software stocks, AI, whatever, and those start to decline in value, you've got to sell something to cover your leverage, to cover your loans. and you're likely to sell the asset that has done well, which in this case is if you're holding gold, you're going to have to sell the gold. Is that your interpretation of these short-term price movements we've seen in gold, as opposed to rethink of this?
Yes, there are very strong indications, just strong data, really, that especially in China, there were, a lot of speculators that had basically leveraged their gold holdings, and there were some changes in legislation that required a larger percentage uh, be held in cash, and so they had to sell some of their holdings, and gold and silver, other precious metals were kind of caught up in that, and so that's where we saw a lot of volatility a few weeks ago. But since then, they've both stabilized, and it's the thing with the fourth quarter numbers came out for gold. There's no shortage of buyers. While there may be fluctuations in investor buying and selling from quarter to quarter, the trends have been set. Uh, it is true that when you have more of your uh, investors buying it in the sort of the kind of fund space, like the ETF space, where you can
Mm-hmm.
quickly sell it. It's much
Mm-hmm.
easier than if it's in a vault somewhere.
Yeah,
You're
right.
not going to sell it as much.
Stick it in your
Um,
car, go to the local. Yeah, right. No, it takes
yeah,
away. Yeah.
and when it's retail investors, so folks who may have an investment account, and they're really they're traders. They're buying and they're selling. You're going to have some more volatility in that supply and demand picture, which translates to volatility in the price. But we've seen that even in 2025, central banks continued to buy significant amounts of gold. And so we think that while there will be volatility, perhaps more volatility than has been seen historically, given an increase in the number of retail investors holding gold,
Mhm.
that the overarching volatility will still be similar to stocks, which it has been historically, um, and provide lots of diversification. So it behaves differently to other assets. Often will do well when stocks are doing poorly, depending on the nature
Yeah.
of that underperformance. So when blended with other assets, it can enhance the overall return of the portfolio relative to the amount of risk being taken. So
Yeah,
that
I mean,
really
I'm
basis.
I'm
Mhm.
thinking back to 2008, where there were only two asset classes that managed to squeak out a gain. One was the 10-year Treasury, and the other was gold. Um, but of course, one of the things that's been unique about this run up is, as this very heavily concentrated market. I even hate to call it the market, because it's like it's a very narrow swath of companies that have done extremely well at 23, 24, 25. Gold has continued to rise. But interestingly, when I looked up, who outperformed the index, like what active manager outperformed the index in 2025, I could only find a couple of them. And one in particular was holding almost 12% of their portfolio, even though they were a stock portfolio, in gold. So only gold
Mhm.
really outperformed or drove that particular manager to outperform. So I'll ask you what I asked you the other day when we were preparing for this. Hey, how come I don't have more gold in my portfolio then? If this is all so great, let's go. Like, let's put some more gold in there. How much should I have?
Sure. So because gold is similar volatility to stocks, and it doesn't yield anything, there's no interest being paid on it. We are limiting the amount. So between all precious metals, it's 1%, and uh, we could increase that, but right now, given some of the volatility seen recently, also. we're limiting the amount. But that's mainly it. So while it does provide certain benefits, you don't want to put too much in because it can be quite volatile. So we just want to be careful to blend it in the proper amounts. And when we were thinking about adding in, certain percentages, 1, 2, or 3, we back tested it, asking kind of what if we had put 1% in the portfolio or 2% or 3%, a few years ago, what, not just what the return differential is, but what the risk differential is, kind of how more volatile did it make an investment, right?
Mm.
What was the kind of daily move of that investment? And we found that the best outcome from that back test was just 1%, and it improved the amount of return taken per measure of risk. Um, and we looked at some of these things also, prior to the significant run up of gold. It's a bit anomalous, but so looking at those back tests further back also, a small percentage seemed appropriate, but we
I
can
was going to
always,
say, you know
depending
what
on,
we really need to get rid of the back test and we need to future test this, Daniel. Wouldn't that be great?
yeah,
We could just like future test it. Let's pretend that we already know all the possible outcomes, but I mean,
yeah,
there is room to, I mean, if it is a sea change, there's room to go up, obviously, but I understand you're trying to be relatively cautious. There's a
yeah.
question in the chat that I think is a good one because I don't think we've answered this. I know it's only 1%, but where'd the 1% come from? What did we reduce to get the 1% to gold? Did it come out of equities? Did it come out of the bond portion? Where did it come from?
It came out of both pro rata. So
Okay.
if you had 60% stocks, 40% bonds, we would have taken 0.6% from the stocks, 0.4% from the bonds.
Okay. Okay. Um, Interesting. All right. By the way, folks, for those of you who are on the call, if you have other questions, please do put them in the chat because we would like to hear your other. And it doesn't. Your question can be on other things more broadly about the macro situation or other things you're worried about. Um, you know. Within the bounds of investment today. There's so much to worry about. Let's keep it at let's keep it on investing for the moment. Feel free to ask your questions and we'll try and field them. Um, I don't think we've talked about this very much. You did talk a little bit about the ETF we're using, that it's linked to the Canadian Mint, that we're not buying physical gold, but we can exchange it. You could, if you had enough of it, the Royal Canadian government might allow you to come to the vault, and you'd probably have to have a lot of it, but they would let you exchange it for gold. But talk to me for a minute about why we think this is a more ethical sourcing of gold, because this is one of the reasons we've always stayed away with it. I mean, gold mining in and of itself is a pretty dirty business and can be an extremely dirty business under the right set of circumstances. So say a little bit about how what we looked at to get to this particular choice for doing this thing.
Sure. So I'll actually let Christian take that one,
Okay, go for it,
and
Christian.
and then we can discuss it in depth. Yeah.
So, the association that governs ethically sourced metals is the London Bullion Metals Association. And they are the group that ethically guarantees whether gold is sourced from the right refiners and foundries. They recently announced their Gold Bar initiative, which creates a secure ledger for each unique gold bar in their ecosystem. So it almost functions like blockchain, but for the actual physical gold. And this ensures the authenticity, trackability, and responsible sourcing for each piece of gold that comes through their refiners and their vaults. And the Gold Bar Initiative is the latest upgrade for the LBMA's Good Delivery List, which charts the refineries who are accepted for their gold and silver and the specifications of their bullion. Through this ledger, the bullion the LBMA tracks not only the country of origin, but also the source of the bullion. So if it came from recycling or if it was newly minted. And for Sprout, they only purchase their gold from Canada's major banks, such as the Bank of Montreal and the Royal Bank of Canada. And for Canadian banks, they are required by law to only buy and hold metals that are purchased through LBMA compliant foundries and sources. And this, again, can be verified through the secure ledger for each piece of gold that is through the LBMA's Gold Bar initiative. And then Sprout stores their metals in the Royal Canadian Mint, where it has the faith and guarantee of the Canadian government. Further, the Royal Canadian Mint is also registered as a refiner through the LBMA, meaning that they must ensure that every piece of metal in their vault is standards compliant. So the RCM, or the Royal Canadian Mint, has been on the good delivery list since 1919, which I think illustrates their longstanding commitment to ethically sourced metals. And to recount, Sprout only buys precious metals from Canadian banks that are London Bullion Metals Association compliant. And because of the association's new gold bar initiative, virtually any gold that Sprouts buys can be tracked with a secure digital ledger to ensure its sourcing and authenticity. And then Sprout stores this gold at the Royal Canadian Mint, which has its own compliance standards and helps to further ensure the rigor of the gold that Sprout is offering to its clients. And so we believe that this creates almost a multi-factor authentication that helps to ensure that the metals that Sprout provides are ethically sourced and that it comes from good places. And specifically, the London Bullion Metals Association has been a leader in helping to track positive outcomes in terms of gold mining, as well as maladaptive behaviors from founders and refineries who are not in their system. And then Sprout is also a signatory of the UN's Principles of Responsible Investing and continues to be a forthright disclosure around metals and mining risk up and down their entire supply chain. So through this process, we felt that Sprout's ETF in particular was deeply aligned with Chicory's socially responsible investment criteria.
Great. Thank you. I have a question about that, but I'm going to take some questions in the chat first. The ETF itself, the question is how liquid is that gold holding? In other words, what's the typical spread there if we were to trade it between a buy and a sell? Is it, what's the volume like, I guess, is essentially the question on that. Mm-hmm.
Sure. So it's a high volume ETF. It's not as high as some of the other ETFs in the marketplace that do not have the same level of physical backing. So there was a trade-off, but it's still very liquid. And so there are no concerns about the spread widening too much there. And especially in non retirement accounts, we're trying to limit volume as well. So we buy this kind of with the idea that it will be held for a longer period of time, especially in taxable accounts. There is a higher tax rate paid
That was
on
going to be
gains.
that's the next question. Can you speak to the tax implications of gains or losses with it relative to other holdings? Mm-hmm.
Yes. So if sold in an IRA or a Roth, there are no tax implications. If it's sold for a gain in a taxable account, instead of paying the capital gains rate, you pay a higher 28% collectibles tax rate. And so, the way that we have this set is that we really won't be, selling this in taxable accounts willy-nilly. We'll be factoring that into tax planning and really kind of in our annual rebalancing. We really won't want to sell it in a taxable account unless there's a really good reason to do so. If it's gone up a ton and we feel that maybe there's a lot, it's over concentrated in the account or something like that, then we might look at selling that. We'd have our tax team take a look at the impacts, but the majority likely be held in qualified accounts, so tax deferred or tax free accounts. But that's one reason that when we were looking at these trade-offs, we weighed our need for liquidity versus our desire to have, really the highest quality kind of ETF that you could have, both from a sustainability standpoint and from a physical backing standpoint. And so the liquidity is significant. I mean, I believe it's over $40 billion in the ETF. Our average daily trading volume is high. So it's not quite as high as some of these others. There's GLD is one that where you're basically buying a percentage of a trust that owns the gold, and they store it all over the place, and it lacks a lot of the same sustainability criteria. Um, so again, it was a trade-off there, but significant liquidity for our needs.
Well, so essentially, I think what you're saying, Daniel, is we're also segregating this from any automatic rebalancing. So we're not going to be trading it as much. I mean, the idea is to buy it and hold it for the longer term as a kind of, relatively segregated holding. Is that correct?
That's correct, particularly in taxable accounts.
Yeah. Yeah, right. In an IRA you could nip at it, but right. Okay. Um, let's see. Uh, two questions from the same client. First of all, are there other precious metals that we're considering? Let's start with that. Are there other precious
Mhm.
metals that are on the table as a possibility? I know we talked for a bit about silver. Uh,
Mhm.
where are we on that? Go ahead.
Yes. So silver we've also evaluated silver and um, believe that silver is a good investment, despite recent increases in the price of silver. Um, I'll try and stay brief on this one. Silver is different from gold in that the sources of demand of the metal are mainly industrial, and so things like solar panels, semiconductors, um, electric vehicles, many of the technologies that we believe will dominate the future are reliant on silver. Similar to gold, silver has a kind of a finite supply chain. Silver is mined often as a byproduct of other mining, whether that's gold mining or copper mining. Um, there are not so many replacements for silver. So when evaluating whether there were any other commodities out there that we might consider investing in to further diversify, investment portfolios, we thought about silver, platinum, palladium, and we thought about copper, platinum, and palladium. Copper has gone up a lot in price recently for similar reasons, but we were a bit worried that copper could potentially see some other options arise that could threaten
Mhm.
its price. Using fiber optic cable instead of copper cables in data centers, using aluminum instead of copper for conductivity just requires slightly thicker, like 25% thicker wire, and aluminum is much more abundant. And so we thought, okay, which metal here has the most uh, you know, exposure to these growth industries, has the least ability, has the least competition
Mhm.
for its uses. And silver is also, I think, increasingly going to become a reserve metal. And investor demand for silver has increased also. And similar to gold, silver has shown to be a significantly, it has shown to be an effective hedge against the devaluation of a currency, which is one of the primary drivers of our thesis.
Mhm.
And so, when adjusted for inflation, silver prices have, while they've gone up significantly recently, are still have still not gone up as much as many believe that they will. And so we think that the recent rally, despite the volatility, is likely kind of a uh, foreshadowing for silver. And so Sprott also has a silver trust, and the LBMA uh, sustainability procedures that apply to gold also apply to silver. And so that you'll see that likely in your portfolios as well. It's a bit more volatile than gold. So it's we're also limiting that significantly within the portfolio, but it's that's the other precious metal that we added. We considered numerous others, but the best two we could find were gold and silver.
Okay. Coming to a portfolio near you, a little bit of silver. Okay. Interesting that it's also becoming more also a store of value. If one can buy gold from the Canadian government, actually, we're not buying gold from the Canadian government. That's important to recognize. Could one buy gold from the US government? No. So we're not buying it from the government. We're buying it and it just is being stored in a government vault. Correct, guys? I got that right? Okay.
Yeah.
So and there are ETFs that are backed by gold that are stored in uh, other places around the country. Does the United States government? I know the United States government itself holds gold as part of its central bank holdings, but aside from
Mhm.
that, does the government itself, akin to or analogous to what Canada's vault is doing for this? Does the U.S. government have such a thing also? Are we aware of that? Does it? Does it do what the Canadian
I
government is doing in terms of using its vault to hold? I guess is what I'm asking.
I'm actually not aware of that. Christian, are you aware of the U.S. holding gold for
For
an ETF?
individuals. Yeah.
I am not 100% sure if they hold it for individuals. From my understanding, the U.S. Mint is not considered an LBMA accredited refiner, so it would not have the same degree of authenticity and verification that the Canadian Mint provides Sprott.
I'll add on here briefly. This is Jacob. I'm an advisor here for you guys who don't know me well. But I believe Christian is correct, and we have privatized that sort of service as we often do in this country. So you will see things like gold held by JP Morgan Chase and other corporations, which we believe may not always be operating in your best interest the same way that the Royal
Really?
Canadian Mint does. Shocker, right? And
I know.
yes, good point though. It's held there. We're not buying it from Canada. So part of the rent or the fee that you pay goes to make sure it's the safest custody that we can find amongst the options available.
I am suppressing, but I'm obviously going to lose my suppression of raising the question of the 51st state. But we'll just let that hang. Let's not go there. Sorry, but one can imagine taking over a government for its holdings of gold, among other things. What's the ETF ticker again for the one that's just been inserted the gold? Can you guys give us that ticker? It was a question in the chat.
Yeah, it's PHYS.
Fizz. Fizz.
Yeah.
Okay. Interesting. All right. Um, Other questions, folks? This has been a really interesting conversation. And any other things, Christian or Daniel, you think we may have not covered today? Questions or other issues? Questions going once, going twice. Okay, may we live in interesting times. I'll just remind you that Happy Lunar New Year. We have finally, thank God, left the year of the snake. And we are now on to the year of the horse. Let's go horse. Because I don't know about you, but the snake was an interesting year, right? Yeah, that's right. Thank you, Tricia, for the horse emoji. We have shedded some things, and let's get on and ride. Courage. I think it's a courage year. I read something about that. I'm a white water tiger. It's supposed to be a good year for white water tigers. I'll let you know later how it's going. Okay, if there are no other questions about anything.
We had one more question in the
Yes.
chat. How do you make a decision on when to buy?
So I think the decision to buy has been made, and in terms of timing, when to buy more, we aren't really going to try and time the market, I guess we could say. So deciding to include gold was kind of the big decision. And so what you'll see is if other assets do very well and perhaps gold doesn't do as well, then naturally to keep it at that, that precious metal sleeve at about 1%, we would buy at that, when we were going in to rebalance then. Likewise, in a tax deferred account, if gold appreciated significantly and other assets were doing less well, then we might, when we go in to rebalance, if it's drifted out of whack with the target, we might sell some at that point and buy into some of the other stocks or bonds that perhaps have not performed as well. Buying it when it goes down relative to other assets would happen naturally. And in accounts that don't have a tax implication, selling it if it way overperformed relative to those assets would also happen naturally in our rebalancing.
So kind of like we do, once we make a decision on an individual holding, we do the same thing. When the rebalance comes along, we buy it and we sell what we're going to sell. And then we continue to do our regular, more disciplined rebalance and avoid the pitfalls of assuming we can guess where the price is going to go, because it's a pitfall for sure. I can tell you, I've tried, and I'm bad at it, and everybody else is too. So I feel like in good company. We're all bad at it. The future is multivalent, very. A great question. Any other questions? All right. Seeing none, I will say we will adjourn, and I thank you all very, very much. Oh, wait, one new. Was it just a thank you? Yes, it was just a thank you. Thank you. You're welcome. Thank you for being with us today. We appreciate your work with us and your questions and your attention. Have a great rest of your day, and happy Lunar New Year.